So welcome to this Opalesque Skills Lab webinar. We're now connected with Kenny Arnott in Sydney, Australia, and of course to a lot of other people who have dialed in from so many different countries and jurisdictions. Some of you are new here, so let me introduce myself. My name is Matthias Knapp. I started Opalesque back in 2003, and of course with the COVID pandemic, we're doing a lot of more things, many more things now virtual. Now, I also need to mention a few regulatory things. This webinar is, as you have read in the email and in the registration process, this webinar is only for eligible, accredited, sophisticated professional investor. So if you're not one of those, please, you need to close the webinar screen now and leave the webinar. This is also not a solicitation, but for information purposes only. This is an educational webinar on asymmetric investing, right? So lastly, of course, most importantly, past performance is not indicative of future results. So with that said, let me pass over to Kenny and start his presentation. So Kenny, I got introduced to Kenny in a couple of weeks back. We have a common friend in Hong Kong who said, well, Matthias, you really need to look at Kenny. He's doing some amazing things, but not many people actually know of him, right? So I looked at him. He's having a track record dating back to 91. And yeah, he will talk about the art of asymmetric investing, which is exactly his style. And we will also run through case studies. And the purpose is to basically give you the investor insights why Kenny thinks this is actually the best way for him to invest and maybe for other investors, and also show you some case studies to learn and to adapt and see how his team finds and executes asymmetric investment ideas. So let me start the presentation. I'm going offline now and over to Ken.
Thanks very much, Matthias, and welcome everyone to this presentation. Just going to begin and reiterate a couple of points which Matthias has made, and that is that this document's been prepared for general information purposes only, and that everybody should rely solely on their own investigations with respect to the subject matter discussed in this document. And past performance given in this document is given for illustrative purposes only, and certainly can't be relied upon as an indication of future performance. Okay, Matthias, I might we've run this. We're going to break it up into a series of sections, and Matthias, I might just let you start with the first question.
Yeah, let me just come back on. So Kenny, why don't you start with explaining us what is asymmetric investing, right? Tell us about your approach to asymmetric investing, as well as, you know, where does it come from? How have you developed this type of investing?
Sure. Best way to start. So what is asymmetric investing as we see it, or, you know, what is it? Basically, the concept of asymmetric investing is something I think is really not spoken about enough when we think about investing. The way that I think about it is it's trying to produce above average returns with below average drawdowns. And to do this, you need to find good investments and not lose money along the way of realizing those investments. Today in this presentation, we're going to discuss how we focus on delivering those two objectives, and how we think that can help other people do that as well. Our approach to asymmetric investing is to, first of all, find asymmetric themes. It's a critical point. That's where we start. And then we look to invest in the best stocks within those themes, while always focusing on macro drivers for both risk and opportunities to generate an asymmetric return profile. Where did it come from? Well, in 1990, I went to work for a guy called Billy Donovan, who was Paul Tudor Jones' uncle, in Memphis, Tennessee, trading cotton. And he introduced me to the concept of asymmetric investing. I then went on to work for Macquarie Bank in the commodity and equity divisions and as a derivative trader. And my skills of risk management were really honed there. Risk management's crucial in the achieving of asymmetric returns. Then in 1999, I founded Arnott Capital and founded at the same time the Arnott Opportunity Strategy. And since then, we have delivered asymmetric return. That's what we think our edge is, and that's why we're a big believer in the concept of asymmetric returns.
Now, Katie, at this point, maybe you can show us some of your results. So how has this type of investing actually worked out for you?
Sure. So I think it's just important to dwell a little bit on history. As Matthias said, we're not necessarily, we certainly haven't been very active more recently. So a little bit of history. Founded the firm in '99. We then ran through and grew assets steadily up to $1 billion in 2008. We had positive returns in 2008, which would have been amongst the best returning performance in that year. We chose the ethical route of not implementing a gate in 2008. There were a lot of redemptions. For anyone who was around back then would remember, and we had some redemptions as well. I chose to wind up the fund, hand back the money to investors 2010, took a break, and then came back in 2013 investing for my family office. And it's only very recently that we've now chosen to reopen the strategy. The point of this slide, these are our quarterly returns, and this is a really good graphical picture of what asymmetry is all about. We talk a lot about in returns about volatility, and we hear about wanting to achieve a rate of 12% with 6% volatility, and I don't think that is as important as the metrics say. I think what's important is downside volatility. That's what none of us like. We're all allergic to losing money, and this return series here shows some really good upside volatility and really good downside volatility. I'm going to talk more about how we achieve that as the presentation goes on. A big part of achieving reasonable asymmetric returns is being able to manage drawdowns in the market. So I've invested in this strategy since '99, and during that time on a quarterly basis, our maximum drawdowns being 9.03%, and as an equivalent, we've seen the market fall around 50%, and very recently with the COVID fall around 20%. If you're going to do asymmetric investing right, then ultimately your return profile of your overall performance should represent something like a call option, limited downside and unlimited upside. And just numerically looking at what we've achieved over a long period of time through very different market cycles, that's exactly what we've achieved. And to bear that out in some metrics, again, the interesting thing here is that if you're a good asymmetric investor, one of the ways that you can achieve that is just not losing money when the market goes down. You can see here that our performance is really just a little over half in up months, but perform very well in down months. And that goes a long way towards reducing risk, but still achieving great results. Now, I mentioned the first tenor of what we do is to invest thematically. One of the things we do, and I'll talk about this more, is about putting a collection of themes together which are uncorrelated with the markets. And one of the benefits of that is that you end up with an uncorrelated investment strategy to virtually any major investment class in the world. You can see this here in our correlations. So that sort of winds up our historical performance. Just back to you on the questions, Matthias.
Right. Can you tell us also more about the workflow within your company, your process, and how do you find themes?
Sure. Really important, right? And I would say that process for us is really important. The concept of having repeatable process, the concept of developing systems that operate consistently is really important. We have a very, very simple 4-stage process. The first thing we do is identify themes. The second thing we do is identify the stocks we want to own within those themes. The third thing we do is identify when we want to get into those stocks based on market factors, and that then becomes the portfolio. If I now dive into that in a bit deeper and have a look, where do we find themes? Because, this is a really critical point. It's all well and good for us to sit here and say that we've been investing asymmetrically for a very long period of time. I think what's crucial is, for you guys thinking about how do we replicate this investment strategy. You've got to have an ability to continue to do what you've been able to do in the past. And that means that you've got to be able to adapt to different conditions, but you've got to be able to replicate the asymmetric payoff in itself. So this is a really, really crucial part of what we do. And we have a mantra that probably sums up best of all where we find asymmetry. Go where the money is not, but the money will go. You're not going to find that in late stage secular trends. You're going to find it in these sort of opportunities. Asset backing, where you can define what the losses are, stocks, themes that are temporarily out of favour, supply and demand imbalances in commodities. I'm going to talk more about that with a case study later in the presentation. This has been really good hunting ground for us finding things, and early stage secular trends as against late stage secular trends. We search in a global universe. We end up with about 100 themes, which we then start researching, looking for stock ideas. We then end up with about 15 to 25 themes, which are eligible for the portfolio, but they're not necessarily in it. And then finally, based on when those stocks reach our criteria from an entry point of view, we end up with about 10 to 20 themes in the portfolio at any one time.
Hey, Kenny, just a question regarding that. So once you have found the theme, right, what factors are you looking at when you then do your stock selection or when you look at the instruments to trade?
Yeah, great question. Look, great question. And at this stage, I'd just like to introduce Yanni Gertos. Yanni works with me on the portfolio management side, and he's going to cover off on this question.
Yeah, thanks, Kenny. So within this stage of the process, we are looking for the best businesses to invest in within a particular theme. The work we do at this point, it's really twofold. Firstly, we scour the world looking for companies that are beneficiaries of the theme that we have identified. And then secondly, we are looking for companies that present the highest risk-reward investment opportunities. And later on, I'll run through some specific examples of how we do this. But for the time being, I'm just going to keep it high level. So for the second part, in determining the best companies that make our shortlist for potential investment, the businesses that we're investing in must, at a minimum, meet the following criteria. They must have a capable management team with a clear, identifiable strategic vision, an identifiable characteristic within the business that gives them pricing power and or earnings growth leverage to the theme we've identified, quality accounting, a prudent capital structure, and we must have a variant perception to that of the market on the security. The last point cannot be understated. We need to see a mispricing of the security by the market, a reason for this, and then an identifiable catalyst that will drive a re-rating or the security towards our perceived fair value. This is a key part in finding and delivering asymmetry. As I'm sure you'll hear Kenny say, we like to go where the money is not, but where the money will go. And I hope that answers your question, Matthias.
Well, so once you find a good stock, you just hold it, right? Or do you trade around it? So who's answering that? Kenny or Yanni?
So I'll probably hand it over and let Kenny handle that slide.
Yeah, all right, thank you. So Kenny, go ahead.
Yeah, thanks, Matthias. Look, I think this is another critical call out on how we think you need to achieve asymmetric returns. We certainly like to identify themes which will last ideally forever, 10 years or more. In reality, I'd say on average, most of our themes typically have a tenor of around 5 years. And we want to invest in names that are going to grow their earnings through that cycle. And as they grow their earnings, we certainly subscribe to the school of see increasing share price. Where we differ is that we don't just buy and hold. And this is a really critical differentiator to a typical long-term investor. We do it for two reasons. The first reason we do it is we find it helps eliminate drawdowns on a stock-specific investment. And the second reason we do it is we find it allows us to actually create a little bit of extra alpha. So how do we make these decisions? We want to be, you can see at the low points on the chart, we're going to have an upside position. And as those stocks rally and perhaps get a little bit ahead of themselves through the cycle, then we're going to reduce that. And let me just talk about what factors we consider when we do that. Break it down into a series. Supply and demand is really important for us. And then, in this day and age, and talking about adaptation, we've got a very large portion of the market now driven by systematic investors and risk parity funds. And it's really important for us to think about what flows are going on and who are the buyers and sellers in that particular name. It's really important to understand events for the stocks and to have views about how those shorter-term things are going to happen. Now, I think the important thing is that we don't necessarily know any better than anyone else how things are going to happen, but everything is about probabilities. And if I come back to this slide, what I would say is that if you're at the first dip in that name, you're going into a reporting season and they've just had a really poor report, they've had a poor quarterly, and you really still like the stock, then you're going to find that we're going to be upsizing that and taking advantage of the fact that the market perhaps has got a little bit negative on the stock when ultimately over the long term it's going to do okay. And then similarly, if it gets ahead of itself in the next quarterly season, then likely we'd be de-weighting that going into a reporting. So that's very important. The third thing are linkages, and linkages are very obvious, but funnily enough, we don't always think about them. There's no point being long an oil stock because you think it's spewing out a tremendous amount of cash and a terrific, meets a whole lot of metrics from a particular investor point of view, unless you have a view on oil, because ultimately it may well be that stock is its entire performance will be driven, by where oil is trading. So linkages are really, really important for us. We're talking about banks. We've got to have a view on where the curve's going to be. If we're talking about commodities, we've got to have a view on where they're going to be, and certainly, thinking about other linkages in particular markets. And then finally, sanity checks. We do a lot of this. I mentioned earlier that our process it's really process driven, but we tend to run a dual track where we've got a lot of quant data coming in. We never make any investment decisions unless we can come up with some sensible anecdotes about how and what we should be doing from an investing point of view. So that sums up, I guess, the process. And just to reiterate, we identify the themes. We then determine which stocks we want to own. We then consider market factors from a timing point of view, and that then moves into the portfolio. Charles, I might just hand over to you now.
Yes, there's another question came in. How critical is portfolio construction to asymmetric returns? I think that fits that point where you are now.
Yeah, it's well, obviously it's very critical. I'd like to make a couple of points. I think when we talk about portfolio management, and I'm also going to delve into how we think about it in a more traditional sense. But I think the critical tools when you think about what's going to get into the portfolio, I'm actually just going to take us back a few slides to probably what is one of the most important slides. We find, certainly when we're looking around the globe, that we are never ever short of ideas. We have an enormous amount of themes that we want to invest in. We have an enormous amount of stocks within those themes that we want to invest in, and yet we end up with very few that actually get into the portfolio. So the crucial point about asymmetric investing and portfolio construction is the role that I play and that Yanni plays as a gatekeeper. What themes are we going to allow into the portfolio, and how harsh are we going to be on that? Because by being very, very strict on the criteria of what themes are allowed in there and what stocks are allowed in there and when we're allowed to upsize and downsize, that is, I'd say, the most crucial point about how portfolio construction is very important in delivering asymmetric returns. Just to talk at a little bit more of a micro level about our portfolio construction, we typically determine our overall exposure, our net delta exposure, by macro views, and we typically determine our gross exposure by our bottom-up thematic view in combination with the macro view. We don't, and not to say that other people can't do it, but we're not pairs traders. Every position in the portfolio is designed to create alpha, long or short, and the only exception to that is that we're typically always running some form of index hedge in the form of short index and puts, and they are for a hedge. The other thing we do is that we set the portfolio up for a broad range of market outcomes because we really have no idea what is going to happen. We think about market outcomes in probabilities, and then we aim to set the market up to survive those different market outcomes. Because I don't think you can be an asymmetric investor without having some form of risk management that involves cutting positions when you think you're wrong. So dynamic stops, profit targets are critical, I would say, to any investor's toolkit who wants to deliver asymmetric returns. We end up with a portfolio that has 10 to 20 themes, and those themes tend to be 10 to 25% of the overall fund. The individual positions within each theme tend to be 3 to 10, and that makes up 50 to 70 positions in the overall portfolio. And the key positions tend to be 5 to 10% of the fund. The other thing I'd say is that we typically like to stay at the liquid end. That allows us, should we think we're wrong, to make decisions to remove that position from the portfolio reasonably quickly. Now, if the first thing that I mentioned around portfolio construction and asymmetric returns is that the portfolio manager's got to be a really strict gatekeeper, the second thing I'd mention is that in my very long experience, and I understand other people may be able to do this differently, I don't think you can run a lot of leverage and deliver asymmetric returns. We've tried to, we're constantly trying to get our gross up. We could obviously deliver much better returns if we could run a lot more gross, but because we're very, very strict on the criteria of what gets into the portfolio, we typically end up with around 150% gross. And nets, again, you know, we will be very aggressive if we have very strong views. These are monthly averages, so they don't necessarily reflect where we may be intra-month, but typically our nets are going to run plus or minus 50%. So that sums up where we think portfolio construction and asymmetric returns come together.
You know, Kenny, you already mentioned the macro and that it influences your trading. Can you add more detail? You know, how exactly are you considering macro factors, macro trends in your asymmetric type of investing?
Yeah, really important, really important. You know, a lot of us in the investment community love delving into stocks and just finding great stock ideas. And, you know, we often talk about the concept of, well, I'm just going to find some great stocks and just let the macro take care of itself. Look, in my opinion, if you want to survive market drawdowns without a drawdown like the market's going to have, you can't do that. You just got to watch macro. So what is it that we watch for macro? Well, the first mantra that we operate under is that any stock anywhere around the world broadly is going to have some correlation to the US, certainly at a country index level anywhere around the world. So we think it's really important to understand what's going on in the US, and then certainly to a lesser extent what's going on in Europe, what's going on in the emerging markets, just to get a real picture of where macro risks are. So number one and most important thing is we need to understand. I mean, and nor us, is actually going to be able to understand what macro outcomes are. We've all seen the stats on macro forecasting, really show that nobody ever gets it right, and we're definitely not going to get it right. I think rather than think you have to get it right to deliver asymmetric returns, what I like to think is all you need to do is really be aware of what you need to watch that may change the market situation. So number one, you've got to watch the Fed. And, and more importantly, and I wouldn't have said this perhaps only 2 years ago, is that you now got to watch fiscal flows, because we're now seeing this sort of crossover hybrid between what was originally central banks effectively running monetary policy. We're now seeing a lot more talk around modern monetary theory. So now fiscal flows are becoming more important. The second thing is you've got to have a view on what's going on in the economy and just follow some basic metrics around what's, whether it's going on with manufacturing, it's going on with sales. And then third thing is really important to understand where valuations are, where earning forecasts are. Now, we're not going to make a call based on valuations alone. I mean, I think it's a really, really poor timing tool that's been proven that. But you just got to have a sense of where you are on the pendulum swing. Are we in the middle, or are we at an extreme? It's all about just making a sensible view on where we are in the cycle. And we really think about market cycles a lot. The fourth thing we want to consider is investor flows. Very, very important, because ultimately, as Stan Druckenmiller has said, the markets are driven by flows. So we've got to understand who the buyers and sellers are and what their inclination is. And then last of all, what current social and political considerations outside of the economy and markets are important. Now, when we consider these, it's really important to think about the rate of change rather than the absolute level. That's what markets get excited and upset about, and that is definitely what we spend a lot of time focusing on, and what I'd suggest anyone who wants to follow macro should look at. And then what we do is we map out a timeline of events based on those 5 factors that we think we need to follow. Now, we're not necessarily going to understand what's going to happen, but just by having a sense of what's coming up. Okay, so we've got Jackson Hole coming up. What are they going to be talking about? They're going to be talking about changing their inflation target. That just gives you a sense of where's the market position for that. Are there risks around that? You're just constantly thinking about things. Now, I just want to run through a bit of a recent case study with the recent market fall, and I want to discuss one of the real benefits of being a thematic investor. So, being a thematic investor is really about, for us, and the way that we do it, running a series of quant screens to identify where there are opportunities, and then doing a ton of reading and listening constantly to identify something which just might be interesting. That's generally how we find things. And I just want to give you an example of, through this research, how we came to be prepared for this market fall. So, we're constantly looking for weird and wonderful opportunities. I think it was around April last year, I started exploring the African swine fever, which has been in Africa for, I think, a very long time. It migrated through North Africa, through the wild boars, and then ended up in China and started to decimate the Chinese pig herd, which is really, really important because the Chinese eat a lot of pork. So I mentioned that we use quant data and we use anecdotal data. I had some, I always think about making sense of anecdotes, and certainly some of the conversations I'd had with people in China was that it was possible that the pig herd in China was going to be reduced by up to 70%. Now, if that's the case, with it being such a large consumption market, there are going to be some obvious winners and losers, and we began exploring who they might be. We ended up putting on some small positions. I'd say that research ran for about 2 months, and at the end of it, we really failed to come up with a sensible investment thesis where we felt there were mispricings, where we could deliver some returns. So we abandoned it. But because that's the type of ideas and things we're looking for as a thematic investor, and the thing about being a thematic investor is some themes are very micro, and some themes have a lot of anchor points around political implications, trade wars, and subsidies that are going on in a particular region. Now, what it meant was when we came into January of this year, the early developments of COVID, which at that point didn't even have a name, we picked, it really pricked my ears, and we were very alert and very aware of what was a probable risk, and we had no idea what it was. But with something as major as that, we made some really, really rash and swift portfolio adjustment decisions. We did three things. We got the portfolio more liquid, we reduced the number of positions, and we shorted index, and we bought a lot of puts. Now, we did that in January, and we actually, and this often happens, right? When you're really ahead of information and you're a thematic investor looking at early stage secular trends, you're going to be early and you're probably going to be wrong. And so at the end of January, we actually stopped out on some of our shorts on the index. We continued to adjust the portfolio and put it in a really robust position just in case this turned out to be something more nasty. And that put us in really good stead coming into March to do two things: massively increase our index shorts through puts and short index positions, and put on a very, very large position in financial shorts. Because if you're going to have some sort of crisis, which is then going to go and affect credit, well, naturally the financials within the marketplace are going to suffer. If I come back and just talk about the number one thing that we think drives the market, it's the Fed. So the next thing that happened was that the Fed acted quite differently to the way they did in 2008, in the sense that they acted quite swiftly with a huge amount of stimulus and going much more directly into the market than certainly we have ever seen in a really long, certainly well beyond my lifetime, really in a long period of time. And so that told us two things. First of all, you've got to respect the Fed. So we lifted a lot of hedges. And second of all, if the Fed's involved in a different way to what they were doing before, then it's less likely that you're going to have some sort of problem in the credit markets, which means being short financials is no longer a valid strategy. And indeed, I'd extend that to say that, one of our interesting hunting ground, for shorts are companies that are a little bit of financial shenanigans where, perhaps they're a little bit stretched in some of their operating metrics, what they're reporting. And again, those companies which had really fallen a lot were ones which we're a little bit concerned might have a rebound under this scenario. So by focusing on macro, we were not only able to eliminate drawdowns, and certainly this has happened 2008 and it happened back in 2000, but in the more recent times we were able to pay attention to the Fed and then lift those hedges and continue to deliver returns more recently. Back to you, Matthias.
Yeah, so Kenny, this is great information on the process of asymmetric investing. Can you also share with us some of the current themes you are looking at? So in the format of the case studies, as we have announced it, now is the time for that.
Yeah, sure. I mean, I might just, before we move on to case studies, so I think I'd sum up, the key to being an asymmetric investor is that you've got to find good ideas and you don't want to lose money along the way to making money with those good ideas. Now, invariably, you can lose money three ways, the way we invest anyway. You can lose money at a stock level by making a mistake about a stock. We do that all day long. I mean, honestly, we just make so many mistakes at a stock level. So, and all investors do, it's really important to remember that. George Soros, I think, had a hit rate of 37%. Ours is actually a bit higher. We tend to run about 50%, but certainly we're making a lot of mistakes. So you've got to be able to manage those mistakes. You've got to be able to manage the losses within your portfolio at a single stock level. The second thing is that we invest in themes, and some of those themes, like African swine fever, come to nothing. We have a lot of themes that come to nothing. So it's really important to manage those poor decisions and actually be able to just throw them out at the right time before they cost you a lot of money. Now, the third way you can lose money, you can lose money when COVID comes around. You can lose money when the GFC comes around. You can lose money when the tech bubble bursts in 2000. And those macro risks that cause huge drawdowns in our portfolios are very, very difficult to monitor unless you're monitoring macro. So we're a thematic investor, we find good stocks, and we monitor macro. That's how we deliver the asymmetric returns. And, I can only suggest to you that it's a way that I'd recommend everybody should be investing. So now let's go forward and have a look at, what's in the book at the moment. You can see, and it is by design, that we like to put together a group of themes which are uncorrelated. Now, why do we want them to be uncorrelated? We want them to be uncorrelated so they don't all go wrong all at the same time, and then that helps us deliver asymmetric returns. We in our long book, we're looking at uranium, we're looking at gold, connecting the future, Hong Kong, agriculture, COVID vaccine and reopening. And then on the short side, we've got accounting shenanigans, crowded, never reopening defensive companies, sharing the social responsibility of COVID. In other words, who is going to pay for it? Someone's going to pay for it. And certainly we've seen REITs globally pay for it. Maybe the banks are going to have to pay for it. We're probably not going to have enough time today to cover all those. What I'd like to do is I'm going to try and give you a sense of a couple of case studies that tie into how the process works. So I'm going to talk about uranium, and then I'm going to hand over to Yanni, who's going to talk about gold and connecting the future. So let's start with uranium. Uranium is one of our classic commodity supply and demand inflection point opportunities that we spend a lot of time scouring the world for these particular opportunities. Following Fukushima, the uranium market has been oversupplied for a long period of time. And so what happens when you have an oversupplied commodity market? Well, you have a whole lot of producers who constantly lose money and either get used to losing money and running at a loss or go out of business. And you have a whole lot of buyers on the other side, in this case utilities, who get used to buying their raw materials or processed raw materials very cheaply, and typically get used to that and become pretty complacent. When commodities go through an inflection point of excessive supply to lack of supply, which is exactly what we're seeing now with uranium, it's because of that mindset of where the buyers and sellers have been, it requires a massive shift. And so invariably, I would say this is probable, but not always, you're going to get some very, very untidy price behavior, and that means a lot of price behavior that may move very, very quickly that presents really, really good opportunities as an investor. So this is one of our classic hunting grounds for looking for opportunities. What is it? What is it that's going to drive this deficit going forward? Well, first of all, the long-dated answer to that is that China has mandated a huge amount of its production, its power generation to come from nuclear sources. Now, at this point, I'd just say that it's really worth considering ways you want to invest and reduce your risk. Now, the great thing about investing alongside Chinese themes is they give us really good transparency about what they're intending to do over decades, and then they tend to stick to that political decision for a very long period of time. And that's very different to investing in other democratic societies where we see governments elected, say, every 4 years, come up with a whole series of policies and then be kicked out of office, and none of those policies are implemented. Very difficult to, or much more difficult to invest under that scenario. So we like investing Chinese themes, and I'd recommend that to everyone. It's a great way to invest. So that's the first thing. The second thing is that nuclear is the only way to generate green baseload, and we're learning a lot more about this now. Europe's making some real changes around subsidies and making nuclear power eligible for the same subsidies that wind and solar are. The third thing I'd say is that there's been an enormous amount of policy uncertainty in the US. We've had various inquiries, really all based around the fact that the US produces a large portion of their power generation from nuclear sources, and a lot of that uranium comes from Russian-friendly countries. And there's some uncertainty over whether policymakers want that to continue at the current rate or not. On the other side of that, we then had lower supply, and the thing I'd stress is prior to COVID, we were in a situation where none of the miners were operating at a profitable level, and we've seen an enormous amount of production come out of the market over the last 3 years. The advent of COVID, we've seen 50% of production removed from the market. We have now more recently seen the largest producer in the world, Kazatomprom, which is largely state-owned enterprise in Kazakhstan. So it does have a free float on the London Stock Exchange. They have just recently announced that they're in the spot market buying uranium to meet their long-term contracts. Now, I mean, the concept of the largest producer in the world making purchases in the spot market to deliver long-term contracts is in itself the most bizarre concept, and certainly, tells us it's a really, really interesting opportunity. The most recent situation, and as I mentioned, part of our process is to always think about catalysts, is that we've got the Russian suspension agreement, which has been in place in the US more or less since the early 90s, and was designed to prevent the Russians from dumping excess uranium into the US market to deliver the US utilities. That was set at a cap of 20% and is due to come off this October. There was probably up until reasonably recently expectations was going to be removed altogether, and certainly some utilities have taken their forward book to be well above that 20% threshold, and now it looks like where the Department of Energy is, and certainly where the political rhetoric is in the US, that will be extended to 20%, and that's just going to see a really, really interesting market where you've got utilities potentially having to now go and source their production from somewhere else, and there isn't anywhere else. So that's at the thematic level. That's why we like the theme. And how do we play that? We've got over probably about 10 or so names in uranium that we own. We've really got a two-pronged approach. First of all, we own physical through some proxies, and one of those is Uranium Participation Corp. And to give an example about how we then try and trade around that position, this chart just shows you the NAV premium discount to Uranium Participation Corp. And when it gets to a big discount, we're going to increase our position. And when it gets to a premium, you can expect us to reduce our position. That's the concept in delivering asymmetric returns where, A, you want to manage your risk. And that is, if it's trading at a discount, you've got a margin of safety, so you want to increase your position. If it trades back to a premium, you no longer have that margin of safety, so let's reduce that position, capture a little bit extra alpha along the way. The second way that we want to be long uranium is we want to be long producers, which are long uranium in the ground in reserves, where we think it's probable that for a percentage move up of a certain move, we're going to get a multiple of that by owning a stock which has got good reserves. So Lotus Resources is one of those. They are currently on care and maintenance, but really, really well positioned to bring back production pretty quickly and take advantage of an upswing, which just almost looks inevitable given this incredibly tight situation in the market. I'm going to leave uranium there and hand back over to Yanni, who's going to talk about the way we invest in gold.
Yeah, thanks, Kenny. So gold is a great example of how we identify a positive macroeconomic theme and then look for the best risk-reward opportunity within this theme. So we view gold as a structural long with multiple years of price appreciation ahead. The reason being, quite simply, gold is a fiat money hedge. We, like many other investors, are concerned about what a dollar is actually worth in this current environment of increasing liquidity. So the last time the Federal Reserve of America rapidly expanded their balance sheet was in 2008, printing over $1.3 trillion, flooding the system with liquidity. In hindsight, this was the perfect setup for a bull run in gold, with the commodity rallying over 155% in the next 3 years. So the setup in 2020 is almost identical, but this time the Federal Reserve balance sheet is coming off a much higher base, setting the stage for gold to appreciate rapidly in the coming years. Now, whilst we like gold as an asset class, it is presently trading through all-time highs and quickly becoming a fairly consensus trade. So as mentioned previously by Kenny, we are constantly looking for asymmetry within a theme. This, more often than not, sees us hunting for value opportunities where we perceive the margin of safety to be on our side. So with this in mind, gold miners look to be the value entry into this theme. Not only have they materially underperformed the gold price move in recent months, but their shares have also ignored the improving fundamentals of their businesses. Consider this. They have a higher selling price for their product. They have significantly lower operating costs considering the rapid fall in fuel prices. And lastly, the huge fall in interest rates globally means that their cost of capital has reduced significantly, which should support higher valuations at a point in time where their earnings are appreciating. So despite all of these positive factors for gold equities, they are trading right near their lowest valuation differential versus the broader market in recent history. So by owning gold equities, we are entering the gold theme with the margin of safety on our side. We are owning businesses that have a structural tailwind for appreciation of their underlying commodity, near-term earnings tailwinds, and a valuation differential that is at historic lows versus the broader market. So all of these factors in concert lead us to believe that equities should outperform in the near term, irrelevant of the broader market. So I'll leave it there on how we're finding value within the gold theme and move on to another theme that's presently in the portfolio, which is connecting the future. So our connecting the future theme is heavily focused on 5G wireless technology. We see 5G as a transformational technology that delivers data faster, more efficiently, and with greater predictability than the prior 4G technology. This increase in the speed of data transmission is set to drive an explosion in the Internet of Things. Ericsson, which is a portfolio company, is forecasting that over the next 5 years, there will be a 350% increase in cellular connected devices, resulting in a tidal wave of data demand. The primary driver of this explosion in the Internet of Things is 5G. It is the connective tissue that will enable the technologies of the future that have previously been starry-eyed concepts come to fruition. So for technologies and concepts like autonomous vehicles, robotic surgery, smart cities, and robotic factories, milliseconds matter, and the deployment of 5G wireless technology enables these technologies to come to market, developing the economy of tomorrow. So as the global 5G rollout commences, we're of the belief that telco operators and hardware providers are now in the perfect position to capture better economics than in the prior 2G to 4G upgrade cycles, as they become solution providers, not just operators. So looking back, the upgrade from 3G to 4G was clearly revolutionary. We went from only being able to send multimedia messages and slowly surfing the web on our mobile phones to seamlessly being able to download and watch whole movies. This saw the creation of companies like Uber, Netflix, Snapchat, and the accelerated adoption of Facebook and YouTube. This equates to the creation of trillions of dollars of market capitalization that the telecommunication companies saw none of. Now, we believe these companies are in the perfect opportunity to claim part of the spoils of the new 5G upgrade cycle. So maybe I'll take it down to a stock level and explain to you how we identify single stock asymmetry within a theme. So I'm going to talk you through Telstra and our investment thesis in the name. So Telstra is Australia's largest telco operator with a greater than 50% market share of mobile and broadband connections. The reason why we like Telstra is simple. We see multiple upside catalysts, a share price that is underpinned by quality infrastructure assets, and market perception that views Telstra as a boring, low-return business that has done nothing in the past 4 years but destroy shareholder value. So look, maybe Telstra does seem a little boring and has been under pressure in recent history. But this is a classic Arnott Capital asymmetrical opportunity. An asset backing that limits the downside with a call option on 5G technology to reinvigorate the industry. So Telstra currently owns a vast majority of their infrastructure assets. They own the telco towers, the data centers, the cables, ducts and pipes, which they have separated into a standalone business unit called InfraCo, with the pure goal of driving enhanced returns from these assets. So we believe InfraCo is worth around $2.95 a share, and Telstra is currently trading at about $2.90. So in our view, this provides a high quality asset backing to underpin Telstra's current share price, with the upside optionality of a demerger of InfraCo or future telecommunication asset acquisitions to drive enhanced value creation for shareholders. So in addition to this, the mobile industry in Australia has gone through 4 very tough years as the challengers aggressively lowered pricing in an attempt to take share off the incumbent, being Telstra. So now, after 4 years of significant value destruction in this industry, we are seeing pricing hold. And this is coming at a time where Telstra is rolling out their 5G service offering, which our research suggests they are around 12 to 24 months ahead of their competitors, giving them a huge advantage and an ability to gain market share and drive enhanced unit economics by offering a superior technology at a premium price point. So looking at Korea as the guinea pig, we're of the belief that the 5G rollout in Australia will result in industry pricing finally trending up. The experience in Korea was that the telecommunication companies lifted prices as they sought to recoup a return on their investment in a technology upgrade. So we see no reason why Australia will not replicate the pattern of Korea, arresting the declines in industry pricing. And lastly, but most importantly, we believe Telstra can become a solution provider, not just an operator. So currently, the enterprise solutions business is around 14% of revenues. But with the upcoming explosion in the Internet of Things, we see this business unit exploding as more and more enterprises seek out innovative solutions for how 5G can be utilised in their businesses. And undoubtedly, Telstra will be there to assist them. So I'll leave it there on our once boring but now exciting Telstra and hand it back to Kenny.
Kenny, anything to add, or should we go to the Q&A?
Let's do that.
Okay, right. So we have a lot of questions came in. Excellent questions, and probably more that we can cover in the remaining time, but let's start. What we will do is all the questions that we cannot answer, I will ask Kenny and Yanni to address those questions in writing and send all the participants directly in Q&A file. So basically, I'm really going to make sure you get all your questions answered. So one question that came in is, what is your differentiator versus other long-short hedge funds? And maybe that can be combined with another question from Ed Strover, who asked, you show performance versus MSCI index, but do you care about your performance versus that index and manage against that index in any way? So I guess the question is, who are you as an asset manager? What's your overarching aim regarding performance?
Yeah, that's a really important question, and I might just start with the second one first. No, all we're trying to deliver is asymmetric returns, and we are completely agnostic as to how we perform relative to other asset classes. We're absolute return managers, and that's what we're trying to achieve. The reason that I think it's important to consider our returns in comparison to asset classes is there's a really interesting situation at the moment right now where a lot of money is invested in bonds, and if you're invested in bonds right now, you actually have a negative asymmetric payoff ahead of you. And what I mean by that is you're unlikely to see bonds go much below zero, really. And bond yields could go a lot higher. So you're effectively short of put by being invested in bonds now. So I mention it as, I think, from an asset allocation point of view, it's a very, very interesting time to consider what we as global allocators, both institutions, family offices, and individuals, what we're going to do with our bond portfolio. Because right now, as an asymmetric investor, I wouldn't want to be invested in it. The second part of the question is, how are we different from long-short managers? Well, the very obvious way that we're very different to most long-short managers is that we don't have drawdowns. You will not find many equity long-short managers with Sortino ratios of 3.82. Now, we've spent a lot of time talking about how the fact that we're an asymmetric investor is how we've achieved that. But that certainly is how it shows out in the numbers. Back to the question.
Yeah, so there's another question which is linked to that. Do you hedge? And how do you determine when your view is wrong? And what do you do when losing money?
Sure. So there are really there are two schools of thought on risk management. If you come from the school of Warren Buffett, you keep a high portion of cash, and when you find ideas you like and they halve, you buy more. And the other school is where I come from. I come from a commodity trading background. I was schooled very early in my career by this guy Billy Donovan, who was a great influence on me, and Paul Tudor Jones' uncle. And as a commodity trader, you use a little bit of leverage, and when you're making money, you increase your bet size, your investment size, and when you're losing money, you cut. So that's how we operate from a risk management point of view. Do we hedge? As I mentioned earlier, every position in the portfolio is designed to create alpha, but we typically run some sort of index short. That index short is largely around us catching alpha versus the market, or because we're concerned that the market is in a state where the probability of it continuing to go up is very low, and so we want to, in that case, hedge the portfolio very aggressively. So we do periodically, and we typically are always running index shorts, yes.
Right, then another question came in. How many securities are usually in a theme? That means how broad are you setting up your themes?
Yeah, 3 to 10 names typically in one thing.
Okay, thank you. And do you have, I know you talked about Hong Kong, you mentioned it, right? And apart from that, do you have geographic allocations in your strategy, or a geographic diversifying aspect?
We have limits, but we're a thematic investor. We would not allow, if we identified 5 themes that were all in Hong Kong, we wouldn't allow them all to be in the portfolio, because it just gives us no diversity around a massive political event with Hong Kong. And so we do set limits around that, so that we, for a real tail event, we have a sense of how much money we can lose. And I would stress, we never know what's going to happen, but we always like to assume a worst case scenario and then try and identify whether we're comfortable with that worst case scenario. We always come from an investing point of view, first and foremost, of how much money are we going to lose before we make any investment, and then think about how much money we're going to make as a secondary consideration.
Right, so we're slowly coming to an end. We talked for 1 hour. Just one last question, and then I'm going to close this webinar. As I said, we will send all the participants a Q&A file. If you still have questions that you like us to answer, we will answer. I'm going to make sure you get all your questions answered. So you can still type a question in the chat, and we'll answer it. Now, there's one question regarding how you trade around your position, which I think is interesting, right? The question was from Jean Crin. When you trade around your positions, is there a cost drag on your returns? If so, what has been the average annual drag? So explain more fully. But you can also turn this around and say, if you make your post-mortem analysis on your trading, what is the alpha of your trading around? So tell us more about that aspect.
That's a great question and a constant dilemma we face. And if I could draw the example of our approach to investing in gold to answer this question, our approach to investing in gold is that we're going to be long and short, and our exposure to gold has been as low as 0, and it's been as high as around 20% in the portfolio. Now, if gold goes in a straight line, straight up, for the next 5 years, then there is no doubt that it would be a far better investment strategy just to be long gold. And if that's what you want to do, then there are far easier and cheaper ways to invest in gold. The reason that we trade around is we would say broadly that gold is going up, but that's over a very long time period, and it's probable that it may have some significant falls, and we've seen that time and time again. So to answer the question, if markets trade around, then typically we're very good traders, and so we do well out of that. If markets trend, then all our trading around is a complete waste of time. So it really depends what market environment we're in, but we're certainly not going to change what we do, because we found that it eliminates drawdowns, And if we're in a trading environment, it adds alpha.
Right, exactly. Makes sense. Right, so we're now at the end. So Yanni, you want to come up again? Just show your face, because when we close, let's all be there and smile and be happy for the hard work. So I'm going to thank you, Kenny and Yanni, for your fantastic presentation. We'll make it available as a replay so you can all watch it again. You can forward it to your friends and colleagues. So thank you everyone for dialing in. Thank you for your questions. Thank you for your time. We hope to see you back at another Opalesque webinar, right? All the best. Be well. Stay healthy. Bye-bye.
Thanks, guys.
Thanks,
Thanks
guys.
very much. Have a great day. Bye-bye.
Bye.